Hi, my name is Nabeel, and in today's video I want to go over what I think is the best way to invest your money, and that is through the use of index funds. It's perfect for those who want a set it and forget it mentality, and it's even something that great Warren Buffett recommends. He says the average investor should put their money into a low-cost index fund. Now, it's certainly a long-term strategy, and it's not something you can expect short-term gains from, so this is geared towards more slow and steady growth over a long period of time. I'll also go over what the difference is between an index fund and a mutual fund is. Then I'll share the funds which I think are good in my opinion. Now, in order to understand what an index fund is, we need to take a step back and first know what a mutual fund is. A mutual fund is where people pool their money together to invest in different stocks and different investments. This fund will typically have a professional money manager who makes decisions on behalf of that fund. So say me and my friend, we both have $1,000 to invest, and maybe there's 50 others who want to do the same. We pool our money together and give that to the money manager. It's now this money manager's job to decide what to invest in. Now, in exchange for this service, the money manager will charge a very high fee. This is because it's being actively managed by someone. Now, an index fund doesn't have those high fees because it's passively managed. Now, technically an index fund is a type of mutual fund, but for the purposes of explaining the difference, we can keep them separate. An index fund is a type of investment that seeks to track the overall success of that market or that index. An index fund will often buy shares in every company listed on the index that is tracking. In practice, buying every single share or bond in an index isn't always possible or cost effective. So if you were to buy the US stock index, you'll have a share or even own a portion of Google, Apple, Microsoft, Amazon, and all those massive companies that you hear of. Buying an index fund is also much cheaper than buying a share in each of those companies individually. What makes an index fund so appealing is 1, very low fees, as it's passively managed. 2, it's diversified. And 3rd, it's very simple. You can access the entire market with one fund. So with that being said, what are some funds you can consider buying and holding? And these are in no particular order. The Vanguard Life Strategy Fund combines multiple individual index funds into one fund portfolio, and that gives you access to thousands of shares and bonds in a single investment. That helps reduce risk by spreading your investments out. Each life strategy fund has a different mix of shares and bonds. Shares typically give you a higher return over the long run, but they are seen as riskier, whereas bonds are more stable, but they offer lower potential returns. Having a mix of both can be seen as a good thing because it helps you balance the risk and the reward associated with shares and bonds. This one really depends on you and what your risk tolerance is. Now, if you look inside the fund, you'll see it's made up of several other Vanguard index funds. This gives you even more diversification because it reduces the risk of any one country's economy. The ongoing charge fee is only 0.22%. The value you're getting from this fund is pretty incredible considering the amount of investments that's been organized for you. If you click onto the price and performance section, it gives you some interesting graphs and tables to look at. If you look at the previous years, you can see the returns. And obviously, as we know, past performance isn't an indicator of future performance, but it does give you a good and broad idea of how it's performed. Now, why do I think this fund is so good? So this fund is an all-in-one portfolio and is perfect for anyone wanting minimal effort but lots of diversification. It's structured to provide steady long-term growth. So the best things about this fund is its automatic diversification. This fund gives you exposure to thousands of individual stocks and bonds across the US and international markets. It gives you balanced risk. So whether you want aggressive growth or something more conservative, there's a life strategy fund which is tailored to your risk tolerance. The fund automatically rebalances itself to maintain your chosen allocation. It's gone ahead and taken a lot of the thinking out for you, which is why for me I think it's a pretty solid fund. The next one is the S&P 500 index fund, and that tracks the performance of the S&P 500. Is an index made up of 500 of the largest publicly traded companies in the US. These are often referred to as blue chip companies, and they represent roughly 80% of the US stock market. By investing in this fund, you're buying into a diverse group of leading companies across multiple industries, and that can be from technology to healthcare, finance, and consumer goods. The ongoing charge fee is 0.07%, so again, very cheap in fees. This fund, like we said before, contains the most valuable US companies. Some of the top holdings include Apple at over 7%, Microsoft having 6.48%, Amazon, Google, Tesla. The S&P 500 index fund is widely regarded as one of the best core investments, and that's because it's a simple and cost-effective way to gain exposure to the largest and most successful companies in the US. And over time, the S&P 500 has historically delivered very strong long-term returns, averaging around 10% per year. This is an average though, so some years it may be higher and it may be lower, but you'll be able to see the general upwards trajectory when you look at it from a long-term perspective. So the key benefits here is exposure exposure to US market leaders. You're investing in the largest and most successful companies in America. These are well-established, financially strong companies that are leaders in their respective industries. S&P 500 has historically outperformed many types of investments over long periods of time, making it a great option for building wealth over decades. And it's low fees. The S&P 500 Index Fund is one of the most cost-effective ways to invest in the stock market. It is focused on US companies, but the S&P 500 spans multiple industries, and this diversification spreads across different sectors. Unlike the Life Strategy Fund, the S&P 500 Index Fund only holds stocks, so that makes it more volatile, and there are no bonds to help balance that risk. This is great for growth, but it does expose you to more risk if the US market underperforms. So this fund is best for those wanting exposure to the US markets only and seeking long-term growth. Now, the third index fund on this list is the Vanguard Total International Stock Index Fund, a comprehensive equity exposure to both the developed and emerging markets across the globe. But the key thing is that it excludes the United States. It has holdings with over 7,000 companies, and the fund spans diverse economies and industries. So this really does offer a good solution for those who want to diversify and look more internationally. Over 75% of the fund's holdings will have a particular emphasis on Europe and the Asia Pacific region, and so the biggest market exposures include Japan and the United Kingdom. Now, with regards to the fund's performance year to date, it's about 9%, so that does reflect some very solid growth in non-US markets this year. And this fund again has a low ongoing charge of 0.12%. Now, exposure to these high growth regions can be rewarding, but it does increase the likelihood of larger swings in value. So if you do choose this fund, you should be prepared for volatility and just remembering to have a long-term view to smooth out any of these fluctuations. Now, another excellent option is the FTSE 100. This is made up of the 100 largest companies listed on the London Stock Exchange, and these companies span multiple sectors. So the industries that you'll find which are represented, they can be financial ones like banks like HSB and in insurance companies. In energy, there are firms like BP and Shell, so two of the world's largest energy providers. You have consumer goods, so brands like Unilever. You have healthcare, covers the healthcare sector, so pharmaceutical giants like AstraZeneca. So only the top 100 companies by market capitalization qualify, meaning they're among the largest in value on the LSE. However, each quarter the list is updated, so some companies might move in or out based on their performance and value. While the FTSE 100 companies are based in the UK, many are multinational. For fees, this fund has an ongoing charge of 0.09%, and it's great for those who want to diversify geographically with a strong tilt towards large cap UK stocks. So these are the 4 funds which you could consider investing in. I've left links for all the information in the description as well. With that being said, have you ever thought about how much money you should have saved by each age? Watch this here to understand how much you should have saved by each decade.